Morning, everybody. Thank you for joining EIC's Energy Procurement Webinar Series Part 2 about procurement strategy. Just have a bit of a slow start to see if there's any people just about to log on at 11 o'clock. Start with some just some housekeeping first. Session scheduled for 90 minutes, so it's a bit of a longer one today. We'll talk about 75 minutes, 80 minutes, I would have thought, about the presentation. Then the last 10 minutes or so will be for any questions that come up. All of the microphones and all the cameras are turned off, so we can't hear you, but there is a Q&A function. So if your Teams looks like my Teams, you should be able to see on the top of the screen there a Q&A button. So definitely would encourage you to ask any questions that you have throughout the presentation. If it makes sense to answer the question straight away because it fits in with the flow, or it's not covered in later slides, then we'll answer it straight away. And if we can't answer it straight away, we'll pick it up at the end. And if we run out of time or we just don't know the answer, we'll take it away and then we'll come back to you after the session. Session is being recorded, and a video will be available to everyone afterwards. So that's that. Just need to click to the next slide. So disclaimer. So as will be confirmed within the presentation, there isn't any, the energy markets are very volatile, which we'll know from the first webinar if you were present, and you probably already know anyway. And there's lots of factors which influence it outside of our control. So there's no guarantees within this presentation about what's going to happen. But you know, that's one of the reasons why organisations like EIC exist, to help mitigate the risk that's present. You know, although there aren't any guarantees, I would say that EIC are in the 50th year of you know, successfully supporting organisations with the challenge of buying from a volatile energy market. So we're pretty well placed to do so. And what this presentation really is about the approaches you can take to, you know, get best value and to mitigate the risk that is there. So with that being said, we'll just skip to the agenda and the introductions. So that's what we're going to cover today. Well, I was at the first webinar if you were present. I did that with my colleague Ramnik, but today we're joined by a couple of different speakers. So I'll introduce myself, and then John, if you want to say who you are as well. So my name's William. I'm from the EIC sales team. I joined in 2010. I've been part of the account management team and part of the sales team, working with public sector organisations, private sector organisations, over lots of different market environments, with lots of different requirements. So I've had a lot of conversations about energy procurement strategies in that time, and you know, still find it pretty interesting now. So that's a good thing. John Palmer, do you want to introduce yourself, please?
Yeah, I'm John Palmer. I'm Director of Flexible Procurement at EIC. So I've been with EIC now for 11 years. I'm working in the energy industry for about 26 years now. Yeah, in a variety of roles, including working for consultancies and for renewable developers.
Thank you.
Hi, John Dawson. I'm the Energy Trading and Market Intelligence Manager at EIC. Been involved with the energy market since 2006 in a trading capacity. Started off with EDF, but been with EIC in its various forms since 2011. Kind of head up the trading aspect of the team is managing risk, and the market intelligence is to do with all of the reports that our clients get that help to give you a flavor of what's going on in the markets on a daily, weekly, or monthly basis.
Super. Sorry, John Dawson, I just realised I've put your name in as John Palmer, so there's two John Palmers, so sorry about that. So that's the speakers. Just a little bit about who EIC are. So We're an energy consultancy. Like I said, we've got a long history and a strong track record of supporting organizations with energy-related solutions. The EIC started off as a market intelligence expert, and since then, because of customer demand and changing needs with legislative pressures and sustainability objectives and whatnot, the range of services we supply is grown. But this session right here is just to focus on the procurement strategy. So what we'll do is I'll just have a little bit of a recap just of what we covered in the last webinar, and then I'll hand over to John and John just to go through the presentation that they've prepared. So the last webinar, if you were there, you'll have heard this already, and if you weren't there but you'd like to see a recording of it, let us know and we can make one available to you. So energy prices are influenced by loads of factors, and the significance of those variables has probably grown in recent years, following the reduction in capacity that we have as a country for storing gas. So it's just made us a bit more vulnerable to price swings as we have to compete globally for the supply that we need to meet demand. The energy prices are volatile and the costs can rise very quickly. So buying from is a risk, but it's something that we all have to do. The way that the market is structured is that that the marginal fuel is what sets the price. So if we have to pay more to attract gas from LNG away from Asian markets or where have you, it means that we have to pay more, and that sets the price for everything. So it provides a lot of volatility to the prices. And lastly, one of the conclusions is no one can know for certain how prices are going to develop. I mean, a lot of the variables that are to do with weather, how sunny is it going to be for solar generation, how windy is it going to be for wind generation, what's the temperature like, is there going to be a lot of heat and demand? So there's a lot of variables which influence the price, as well as the geopolitical issues, which can be anything. So news events will have an impact on prices, and because there's that vulnerability, because there's just not as much supply to meet demand as what there was a while ago. So the objective of this webinar is to really look at how organizations can approach the challenges of buying from the market to achieve whatever the procurement objectives that you have as an organization. So with that, I'll hand over to John Palmer. John Dawson. Apologies. If you just want to set the scene a bit more about the market, and we'll get going.
Yeah, thanks, Billy. Yeah, so this first slide, we're going to look at power pricing over long term. Here we're looking at prices over the last 20 years. So it's an evolution of market prices over the last 20 years. Each kind of line in there is an indication of forward pricing, season pricing. So your summer contracts or your winter contracts. Summer contracts cover April to September, and winter is October to March. So it's trying to show the journey of price here over those 20 years. The scale that we've used in this instance, we've used a log scale so that we can actually capture, the extent of the price move. If we used a normal linear chart, it would be a flat line between 2004 and 2020, and then this massive skew that we've got on the right-hand side. So we've used a log scale, and just think of it as every line up is 100% increase in cost. So we started in, well, for the case of this slide, we started in 2004 looking at prices in the 20s, 30s, and subsequently went up in 2008 to the 80s. So that's almost like a fourfold increase in price. So we've had movements in price that are large in a sense over time. But I think the reason we more wanted to show this chart is that prices are never stagnant. I think everybody kind of knows that. They don't necessarily move in a straight line over time, as you can see that here. We always have a trend depending on what time frame you're looking at. So at the start of the chart on the left-hand side, we're going an uptrend basically up until the £80 mark. Then we have a downtrend, as we call it, and then we have an uptrend again. So the markets are constantly evolving, constantly changing, based on various factors. 2008, I think, was going into 2008 was a commodity boom. Gas prices were heavily linked to oil prices at the time because of long-term contracts. So, however oil moved, gas and power were quite heavily influenced by that. But you can see quite a stabilization in price between 2008 and 2020, in a sense. That there is a range, in a sense, but within that range, the prices are trending up or down. There are various factors for why, say, 40 is a level for the downside and why maybe 80 is a level for the upside. Energy is in itself, certainly from a generation perspective, you do get a substitute of product that can come in if a certain price is too high. So, for example, if gas is too high, you get more coal switching, or oil comes in to create more power. If prices drop too low, you get maybe gas producers turning off, and it offers support kind of support, offers support to prices at certain times. So prices have tended to range within that, but obviously with the crisis that we had with the Russian gas crisis, we've seen prices obviously rise significantly. Obviously, this hasn't been seen before, and the extent of the rise kind of dwarfs everything else that was there in the past. It has to be said, obviously, the decline since then has obviously been of a magnitude as well. I guess another thing to maybe look at here is that it's more like a observation again, that prices since the decline have come back to the top of what we consider a range over the past, the from 2004 to 2020. So that 70, 80 level, and since then, since April this year, have since found a bit of a recovery since then. So there has been dynamic shifts in the market over this time frame, be it gas being heavily linked to oil and then that disappearing because now we've got more liquefied natural gas coming to market. That means we've lost some influence, or quite a lot of influence, of oil influencing gas prices and therefore power prices. Now we have more of a higher link to liquefied natural gas, which in itself is a global market. So things that happen in Asia, the US, Australia, will have an influence on our gas and power prices, more so now. The increase in renewable in the mix for generation purposes will also have an influence on price. So the ingredients that shift sentiment in the market have shifted. The influences on price have shifted. Sentiment will kind of always shift bullish or bearish dependent on those ingredients, how they mix up over time. But the key takeaway to take from this slide was just more the fact that price is always moving, always evolving. We can never know from here what's going to happen on the right-hand side of the chart going forward in time. But as we go through the presentation, the idea is that what can you do to insulate against the rises, and what can you do to try to take advantage of, if prices drop back down again. On the previous webinar, there was indication of here the bearish and bullish views. So we've just put them on to kind of describe some shorter term, some longer term bullish bearish factors that will help prices push up or down. Just the last thing to take away from this is if we do drop down, we'll probably go down into a 40-80 range again, back to normal. But there are still some overarching influences in the market that if they do come to fruition 80 could be the floor, and we could be anywhere between 80 and an unknown at this point upper range. But time will tell. And again, the market will always move, and we'll just have to kind of take steps along the way through that journey of price discovery.
Okay. Yeah, just to talk about choosing the right strategy for you. So I think the key for this is that no organization has a correct strategy. It's about understanding what you need, when you need it, and being able to adapt that strategy over time. So the right strategy this year might not be the right strategy in 3 years' time. It will depend on market conditions, on what you're aiming for from your contract, and whether you look at fixed contracts, whether you look at flexible contracts, whether you move between the two. The key really is to understand what you're looking for in the market at any particular time, and to make sure that you're tracking the market, so that when you're making those decisions, you're making key decisions about when to go to market, how long you're looking for contracts for, and what best value actually means for you. So timing is key. Particularly for fixed contracts, obviously you get one bite of the cherry in terms of making that purchasing decision. So it's about when do you actually make that decision, and how long before the renewal of your contract do you start looking at that. We hear a lot of people talking about, I always renew my contracts in the summer. I always renew my contracts at the same time and for the same duration. And I think one of the things we're trying to do in this webinar is perhaps give you some context of why that might not always be the right decision, or at least some alternatives to taking that approach. So yeah, the key is that signing at the same time of year for the same duration, that might not always offer you the best results. Just taking 2020 as an example, when the market was very low, potentially signing a long-term contract then was a great decision. In 2022, possibly signing a long-term contract was not quite such a good decision. So we'll go through some of the different types of contract that are available, how you might want to look at timing of those contracts, and some of the things that we would look at from either a risk management point of view, particularly when you're looking at flexible contracts, and how market conditions can affect some of those decisions. So not wanting to teach grandma to suck eggs, but I'm sure most people on this webinar have been involved in a fixed contract at some point, but just want to give a quick overview of what they are, what they mean. So with a fixed contract, you make a buying decision on a day and you fix your wholesale energy cost for the duration of the contract from that point. It gives you a very high level of budget certainty. So if you are trying to work out what to charge your customers, or what to put in your budgets, obviously this is the highest level of budget certainty you can have. It might also be the only option available to certain customers, because there are typically minimum thresholds for flexible contracts. One of the things we are seeing in the market is more flexible contracts becoming available, more types of flexible contracts. So, in certain cases, that means that you can get a sort of semi-flexible contract, perhaps a fixed or floating type model, or a gradual purchase option, but it won't be a full flexible contract. So it's understanding what kind of contracts are available to you, but from a fixed point of view, knowing that on a day you're making a decision, you're signing a contract, and you're locking in a price. For most fixed contracts, we'll see customers deciding to fix their non-commodity charges as well. So that's the costs that get the energy from the point of production to your meter, and any government taxes and levies that go alongside that. With a fixed contract, you can't benefit from wholesale price movements once you've signed it. So timing is key. But one of the benefits that a lot of organizations see when they're looking at fixed contracts is, to be honest, once you've signed it, you can almost forget about it until the point that you start looking at that renewal. And arguably that point could vary depending on what market conditions are doing. And so looking at this, this is really looking at timing of contract. So if you're procuring a fixed contract, how do you decide when to go to market? Is it that we always sign our contracts in July, or is it a case of you're tracking the market actively? Have you got the information that you need to do that? So market intelligence, data that's there to help you track that market. For a lot of our customers, they will have a price level in mind that works for them in terms of signing that contract. So the key there is to make sure that you understand what that level is, and if you are setting a level, when you get to that level, it's actively looking to sign contracts around that time, rather than necessarily gambling and sometimes losing by doing that. And the final point to make is around the length of the contract that you put in place. Depending on what the market's doing, a longer or a shorter term contract might be the right thing for you at that particular time. So again, you might not always want to sign a 3-year contract or a 12-month contract. It's about varying it based on the different market conditions. And this graph is aiming to give you an idea of kind of what you might do in different conditions. So, if you're looking at this graph at the moment, the sort of dashed horizontal line is the contract renewal date, and then we're looking at the decisions you might make. So, do you buy at the top of the market and panic? Is it a case you take a measured approach and say, right, I'm going to buy if the market hits a certain level? Or are you a bit lucky and you happen to leave it to the last minute, and at that point prices happen to be reasonably low? I think it's for us, it's about trying to take that level of either panic or luck out of the market and take a more measured approach about when do you actually sign that contract, and how do you decide when to go to market. So flexible contracts, slightly different and possibly new to some of the people who could be on the webinar. So with a flexible contract, the wholesale energy is actually traded through the course of the contract rather than all at one time. So you can make multiple buying decisions over time, and that will give you the opportunity to optimize your position in the market by buying and potentially selling back energy right up to the point that you actually consume it. Flexible contracts typically tend to be on the longer side, 24 to 36 months or even longer. That gives more time to optimize positions, to trade and take advantage of market trends during that time. Some of the downsides we sometimes hear about flexible contracts is they do require a bit more input. There is, whilst we can manage trading on your behalf, there are decisions that need to be taken, and there are inputs needed to make sure that you're getting the most out of that flexible contract. And as I mentioned on the last slide, there are different types of contracts that could be described as flexible. So we are seeing more contracts coming into the market, like fix or float type contracts. So you can either be completely exposed for a month or completely fixed for a month, or perhaps certain contracts which will allow you to buy in chunks, in tranches, to cover your volume. So whilst those are, they're good for some customers who aren't big enough to have a full-on flex contract, if you're big enough to have that standalone flex contract, I would say make sure that contract allows you to implement your trading strategy, what you need, and that should be a bespoke strategy that allows you to get what you need out of that contract. So it's important to make sure that when you put that contract in place, things like flip sizes, which the amount of energy that you can buy in individual trades, are as small as possible to help you have more opportunities to buy and sell. It's making sure that you understand what's happening with the non-commodity charges in that contract. It's making sure you know about any fees that are in that contract, in terms of fee for selling back or a fee for rebuying positions. So yeah, that's the complexity of a flexible contract, but it does give you that opportunity to make more decisions or more trading decisions, and hold off purchases. For example, if the market's falling, or buy and then sell back later if the market rises and then falls. So in terms of strategies, I think that the key thing for any organization is to understand what you want from a flexible contract and from that strategy. It's risk management. It's not risk avoidance. It's managing that risk that you have, and the key really is understanding how much risk you're happy to take and what you're looking to gain from that flexible contract. So, are you looking for budget certainty? In which case, you're probably going to take a more conservative approach. Do you want market reflective pricing? Do you want to chase the market down if there's an opportunity to do that? And are you willing to take the level of risk that's needed to do that? And what we'll try and do is work with you to make sure you get a strategy that balances risk and reward with those needs and desires. So it's really aiming to understand almost where you sit on that scale on the image on the left. Are you looking for something that is very highly fixed, like a fixed contract, or a level of budget certainty, or do you want something that's more market reflective or more aggressive? And it's kind of understanding that you go from budget certainty on the left side of that to probably much more market reflective pricing, but more risk on the right hand side. And just to talk you through some ways that you might be able to achieve some of those goals. We've got some specific ideas of the types of strategies that could be used. It's important to say as well that whilst there are different types of strategies you can use different strategies for different periods or combine them a bit, so that you're not fixed to one particular option. But when you're looking at budgets and budget certainty, what we would say is that the important thing is understanding when you set your budget, and how you set that budget. So what we would typically do is on the first day that you can trade, we set the baseline, and that's the cost of buying all your energy on the day that you start trading. You add an agreed level of capital at risk to that. For most organizations, that will typically be between 5 and 20% of your wholesale only cost. And that sets the budget. That's the limit that you don't want to go above. And then the aim of the strategy is to make sure that if prices are rising, you're buying to limit the risk to the budget. But if the market's falling, you have exposure to that and you can take advantage of those lower prices. That might be a case of not buying initially if the market's falling, or that might be a case of selling back at the right time to give you that opportunity to benefit from lower prices. But yeah, this is designed to give you that level of budget certainty with an opportunity to save, based on taking trading decisions during the period that between signing the contract and the point that you actually consume that energy. Another way of buying your energy is on a time-based approach. So it might be that you want to look at buying proportionally over time, just to smooth out whatever the market trend is, and your cost will follow that trend, and you will end up with more certainty as you get closer to the point of delivery. So in the graph you can see on the left hand side of the slide, the grey portion is your energy cover increasing as you go over time. The black line on there is the market price, and then when we click through to the to show the red line, that shows the impact of the purchases on the position and an increasing level of certainty as you get closer to the point where you're going to use your energy and you have that 100% fixed. But the important thing with this is to is to apply this in the right market conditions. In a rising market, you'll follow the market up. In a falling market, you'll follow it down. So it's about kind of understanding what the market's doing and what you're looking to achieve and why you're looking to achieve that. Do you want a market reflective price because that's something you pass through to customers, and having a market reflective price is more important than having the lowest price or a key a key budget level for you. So it's much more about buying proportions of your energy over time, partially depending on market conditions and partially depending on perhaps a time-based approach. And one option to sort of tweak that slightly is to use triggers when you're buying, rather than just leaving it to the market, and that kind of can give you a bit more control by limiting the risk that you're taking. But if the market is falling, it means you don't necessarily have to buy as early. So with this sort of strategy, you'll see that prices, as they fall, if you've got an upper and a lower trigger, or perhaps multiple upper triggers, you can see that with this example, the market's falling. Every so often we lower the triggers based on a lower trigger being hit, and then when the market subsequently rises, you buy because the upper trigger's hit. So it just gives you that opportunity to limit some upside risk whilst following the market down. So obviously market conditions will impact those strategies. I've sort of mentioned that with a market tracker-based strategy, that will have an impact, but the market will impact all of those types of strategies. So with fixed procurement, timing is everything. So we've got a graph here just giving you some seasonal prices and the day ahead price, but just to give you an idea of what it means if you choose to buy at certain times. So potentially, looking at this example, good timing means you're buying at less than 60 pence a therm, which obviously is good news. We see the market start to rise. Potentially you choose to buy at that point to mitigate risk. Again, you're probably buying somewhere in the 60 to 120 pence a therm cost range there. The market then carries on up, starts to run away. Is it a time to where perhaps there's a panic buy because prices just reach a level that you can't go above? In which case you could be looking at prices well over 240 pence a therm. Or do we then see prices start to fall, and do you set a level which you want to reach before you buy? And again, that target level might mean that rather than buying at well over 240 pence a therm, you say, well, if we get back below that, that's where I'm going to buy. So there are different, those 4 different purchasing decisions make a huge difference to what the price is. And I think when we're looking at those purchasing decisions, the key there really is to look at the market over time, keep looking at the markets, and make sure that depending on what the conditions are, you've got a view of when you want to make that renewal decision. You can look at it and say, what's the year-on-year cost change for me? Is it a cost change that either is an acceptable increase or shows a discount on the previous year, which might be a win for you? Is there a level that you want to draw a line at to say, if it gets to this level, I'm just going to take any risk off the table, because that is something that we can't manage without. I think with what happened in 2022 and the way prices moved, a lot of organisations struggled when they ended up having to buy into these prices of 400-500 pence a therm plus. It was a huge price, and whilst there was some government support, that was there was a limit to that support, and it did mean that a lot of organisations struggled as a result of buying at very high prices. So I think having an idea of what you're looking for from that renewal and having an understanding of what's happening in the market is key. and then looking at some of those different strategies. So looking at a budget protection strategy, again, timing of starting to set that budget is key. So if you set a budget at a low point in the market here, then what will happen is you will start to buy very early, because prices are rising. We need to protect the budget. In that instance, you're going to stay below the budget. You're going to miss. You're going to avoid the significant cost increases that we saw in the market after that, and then potentially, as the market falls, have opportunities to sell back some of the volume that you previously bought, as long as the budget would allow that, to make some savings. And one of the things to mention is that, with a strategy like this, you might put in something that's designed to lock in savings, in which case your budget can come down as the market comes down, to lock in some of those savings as you go. So yeah, with this strategy, in these conditions, it's limited the upside risk in the market, and then has given an opportunity to save later on when market prices falls.
Yeah, this is where, if I can just mention something, this is where with the budget protection, we are utilizing tools as well in the background. In the examples you were shown previously, where you had a baseline and a budget, you're talking about the margin. We stress test the conditions the markets have gone through to ensure that that margin isn't eroded such that the budget is breached. So there are tools that are being used in the background to ensure that there is protection to that budget. Traders themselves will make decisions subjectively as the market's moving as to whether to have cover against a rising market, or how much exposure to have in a falling market. But that's also dependent on how much of that margin's left over or can still be utilized under those market conditions. So in this example, if the market price is rising, and say nothing has been hedged, or a proportion has been hedged, every time the price rises or goes against, that margin is being eroded. So its capacity to manage some previous high volatility that was there over the past year, that window of opportunity or the exposure to that risk is increasing as the margin's reducing. So traders have to step in and make decisions to ensure that that margin is protected, such that it can be utilized later on when prices are falling, such that now you can sell back and utilize some of that margin, increase the risk again, as it were. So it's quite a balancing act that happens from the start of trading or start of contract to the end of a contract. And also the underlying market, the way the prices are moving, has a massive influence on the positioning then that a customer will have. In this instance, because we're using quite extreme price moves to illustrate this, if someone's starting at this point, moving from 50 to 60 is quite a large price move from the starting point, because the beginning price is low in a sense. So a 10p move is quite a large move comparative to the starting point. So a trader would be forced to have to make those decisions quite quickly, or the stress test in the background would be already indicating that something needs to be done to cover a position. So different brokers perhaps will attack this problem in different ways, but the way we'll utilize it is we'll definitely have a stress test model behind us that is at least feeding out a calculation that is saying how much, whether you've got too much exposure to the underlying conditions or not, and also how much volume can you sell back to stay within the threshold to take advantage of falling prices. Yeah.
Thanks, John. And yeah, just to give you an idea that budget protection strategy can operate in all sorts of different market conditions. So in a rising market, in a falling market, in a sideways market, and there are different ways that traders can utilize that strategy to try and achieve savings. So it is about managing based on market conditions as well as the budget. And yeah, just to illustrate that, this slide shows what happens if you start a budget protection strategy much later on that graph, when market prices have risen significantly. And again, positions would have to be fixed to protect the budget. But in this case, fixed at much higher levels. And then we'd be looking at selling back some of that volume to buy back at lower prices to reduce the cost. But because of the level of risk that's there in the market and the high starting point, the budget protection strategy won't necessarily follow the market all the way down. It will only gain some of that opportunity.
Yeah, that's another good point to bring up. I think some people view the budget protection and the flexibility as being able to take, full advantage of a drop in price, but you cannot sell back, for instance, in this case, 100% of the volume back in order to gain 100% of the falls. Because in doing so, you would have 100% exposure to a market. So if the market was to tick back up again, you would quite easily breach your budget. So it's important to note here that the proportion of volume that can be sold back is one determined by the volatility that's happened in the past and how much of that margin or that pot that you still have available to do so. So it is not a, it's not a, it's not a strategy or a form that kind of, if you remember the scale that you saw on a previous slide, it's more skewed towards certainty than necessarily fully towards opportunity. And so the skew is more towards higher risk management than necessarily getting the lowest price possible. So as we go through this slide, just remember that scale as much as possible. That's you will gain some advantage on the drop, but it is not going to be of a magnitude, for example, as the drop is. So you will still lag as far as price, the price you'll end up achieving, but it'll certainly beat fixed price in this sense. So a budget protection is more akin to try to beat the fixed price model, but with a lot of with some certainty in the in the budget protection strategy that you can achieve something similar to a fixed, but when the opportunity comes, you can end up with a better price at the end of the exercise as well, if the market allows and if the right decisions have been made in that process.
And then we've got a final example on the budget protection side of things, just looking at what happens in a falling market. And again, similar situation. The budget's set on the first day that you're trading, but in a falling market, rather than looking at a very highly fixed position, you'd be looking to keep as much open as possible. As John said, that capital at risk will allow you to do, and that the risk model will allow you to do. So the aim will be follow the market down with as much volume as possible, and then a subsequent rise, just purchase a bit more to reduce the risk. And in that instance, potentially you will capture a chunk of that fall, but again, not all of that fall, because you will have to have some positions fixed when you start trading. But it gives you an idea that that strategy can work in different types of market conditions, but probably there are some where you are more focused on reducing and limiting risk, and others where it's more about how much risk can you take to try and follow the market down.
Yeah, and then the difference between, you might wonder, why is this any different to the previous one we saw? Like in this instance, we've seen a more of a sharper decline. So a trader might look at this and say that there is perhaps more opportunities available here than, say, and on the previous graph where we were much more to the left when we started. So when you've come in and the market is pulling down, you sort of want to stay with that trend as much as possible. So you will want to stay to the maximum of the limit, as it were, on the risk side to try to gain, take away from the market the best opportunity possible. So your skew to risk is slightly more on the opportunity side at this stage than it was, say, maybe just a few months before, when we were still in the very early stages of a pullback, in a sense. So later on in the stage, you probably have a bit more confidence to have more exposure to the market. But again, that's also dictated by the model saying how much risk can you have exposed as well. But you don't maybe necessarily need to buy a very high proportion as you would have in the previous example. This time around, you probably don't need to necessarily go as highly fixed as you would have previously. Hope that makes sense.
Thanks, John. So yeah, just to give you an idea of a different strategy, market tracker, just to give you an idea of purchasing over time, what that might do in these conditions. So again, you know, we're quite towards the left-hand side of that graph. So that first purchase, you know, conditions are quite flat. Initial first purchase is made. As the market's rising, you're buying that second chunk. The third chunk's bought as the market is coming closer to the peak, and then you buy, you make a fourth purchase, and that gives you a position which, whilst the market's been trending up, you followed the market to some extent, but you've smoothed out the volatility and the very highest prices. You know, you've only bought a proportion at those much higher prices. So as an average, whilst you've gone up, you've ended up at a lower point than perhaps buying everything at that high as you might have in a fixed contract. So really, the aim with this is to buy the energy over a period of time and generally follow that trend and look for opportunities. And again, in a falling market, which the next slide will show, you would be looking to sort of do the opposite and follow the market down. One of the things that would change that sort of trend slightly is if you put triggers in place, and those triggers, you know, if triggers are based on certain price levels, then obviously you'll be buying well before those highs that the third purchase is made at. So yeah, with buying in a downtrend, again, you know, if you start trading in a falling market with a market tracker type strategy, you know, it would be looking at trying to buy those chunks as the market falls and taking the opportunity to you know, to see the position head down with the market. You won't necessarily, you know, you won't hit the very bottom of the market, but the trend will head downwards, and follow the general you know, the general direction of the market. So the opportunity is there to you know, to follow whatever the market conditions are doing, and if that's something that is important to you as far as say selling a product, or costing your energy, you know, it's a good way of managing that cost over a longer period of time.
Yeah, but again, I'll mention that with the tracker as well. I mean, the difference between the budget protection and this is with the budget protection, you're kind of already quantifying your maximum cost in a sense, whereas with the market tracker is less so. So for the example of the rising market in a rising trend, uptrending price, while you're taking away the volatility and you've smoothed out your achieved price in the end, the fact remains that your upside isn't capped to a degree. You're kind of exposed to the conditions as they are, and you haven't bottled risk in a sense. In a falling market, it can work better, say, than a budget protection, because you can have a lot more exposure opened to the declining prices. But again, there's no guarantees that the markets are going to continue to drop. So your skew is to a lot more risk on a market tracker, because so on your first purchase that you've done there, if the price then continues higher, you just don't know at what levels necessarily you're going to procure the following tranches. So risk is much more open in this perspective. So yeah, I guess it's always a question of, can you take this one knowing what the trend is at the time, perhaps, and it will make that call a lot easier. But it's also understanding that the risk is quite open, that something can come to market, and when it looks like an obvious downtrend, can shift and change things. So again, it'll always come down to how the business views risk. In every case, I guess, or depending on whichever strategy is taken.
Yeah, and I think that's the key. It's market conditions. Are the market conditions right for this type of strategy, and is that delivering what you want from that from the market, based on that? So it's important to take that into account when you're making any decisions about how you want to buy your energy. I think I'll hand over to John just to talk a bit more about some of the sort of shorter term day ahead positions. We do hear the point being made that day ahead prices are always the cheapest. So John's got some analysis to sort of talk through around day ahead prices.
Yeah. So for those who don't know, you can procure your gas or your power on the day ahead. So like today we're pricing what gas and power for delivery on the 3rd of July is, today and on the 2nd of July. So there is, in the wholesale market, which your supplier would go to fulfill that obligation. If you haven't secured any gas, say for July, or power for July, and it's on a day ahead basis, your 3rd of July, the price of your energy for the 3rd of July is being priced today by the end of today. And every day's pricing happens over the course of the month, and you'll get an average price for July based on those daily inputs. So some customers will go on a day ahead. Admittedly, not very many, but some do. The day ahead is supposed to be a reflection of price, given all of the inputs that the market has on what that value of energy should be on that day. So everything we've looked at so far, when you look at the winter 24, it's a forward look. What will the winter be like? What will transpire? What might go wrong? What might go right? And the market's trying to juggle all of that before we get into winter. And then over the course of the winter period, you're going to get these daily inputs that the market is deciding on what value should have been or should be. And what we're looking at here is, say, the winter 2005 as a first input is a year ahead of the winter 25. What was the average over the course of the year? What was the average price that the market decided that the winter 25 should be at? And that was at 44 pounds and 9 pence. The reality was, through October 2005 into March, the daily input turned out at 59.04. So looking ahead, the market on average was working out at 44 pounds. The reality ended up about being 59 pounds per megawatt hour. Okay, so I hope that makes sense. So when we're looking at forward pricing, we'll call it forward hedging and all of that, versus a reality, what did it turn out over that delivery window, that winter 25, October 2005 to March 2006. So this shows that pretty much it's split 50-50 to a large degree. And you can see the 2021, 2022 most specifically, you saw that massive uptick in price. A year before delivery, that winter contract would have been at 78.87 on average. The outturn on a daily was obviously quite high. So that's showing that during an uptrend, if you catch it early, you forward hedge early, you can beat the reality at some point. But also vice versa. If you catch the forward hedge too high in the uptrend, when the reality can turn out to be quite different. So the downtrend, the day ahead will win. In an uptrending market, the day ahead seems to lose. So if we transpose this on the long-term chart that we saw at the very start, when we see prices on an uptrending, it tends to be that the day ahead will outturn higher than if you had bought it in advance. I hope I'm not confusing anyone there. That's quite clear. Now, it's the same for the winter, which is the next slide. Sorry, the next one is a summer as well. The outturn, the reality can also be quite different from the forward hedge. Now, some will never look at their head and you'll never look at it and consider it as an option. But I think those who have a high enough volume that allows for strategies such as the ones you've seen before, if your volume is of a large enough proportion that suppliers can start again. If your volume is large enough, you can look at ways of splitting your strategy into different groups. By that I mean, say if you're a 5 megawatt user, let's use 6 megawatt user. Sorry, I say that quite 6 megawatts a month, a season, right? Just for ease of comparison. 6 megawatts you use over the winter. What you can do is split that, where you can have these multi-strategies, where you can have a budget protection, a portion of that, a market tracker for another proportion of that volume, and a day ahead for another portion of that volume. These are things that can be considered. You can mix it up a little bit. If, again, we say market conditions again and timing, if we think of the price chart where we've come down since the crisis, and now we can look at it and then analyze it and maybe think, what can we do different next time? So you could look at that and say, well, I want a high proportion of my cost. I want to know what that is, but I'm willing to let a 10% or 15% of that volume kind of float, because how long will this situation necessarily last? And am I willing to allow a floating position or some of that volume to just go to day ahead, because the outturn may not necessarily be at these high levels that the market is forward-looking and anticipating. So that could drive down the cost if you're in a downtrending market. But the idea is to know when that downtrending market's happening. And again, it always comes back down to when have you signed your contract and come to market. So if we're in the conditions that allow for it, going some proportion of volume to day ahead can be beneficial. On the rising market, obviously, that negates it. So if you know we're in a rising market, then don't necessarily consider it. So if it's about trying to get price or the best cost for yourself in a downtrending market, try to consider a day ahead proportion probably in your volume. That's if it's possible. And the other thing is also the day ahead can allow for those who are uncertain on volume, because volume is a massive risk. If there's a lot of volume uncertainty, you can leave some volume to the day ahead. As you can see, sometimes you'll win, sometimes you'll lose over time. But if the volume is a higher risk on cost, then leaving a proportion to the day ahead can be a winner at times for you, and sometimes not necessarily work. But the price difference between a forward hedge and the day ahead on these tables pre-crisis are not that too far necessarily. So if it's a small percentage of volume that goes to the day ahead, negate some of the volume risk, it's probably worth something to investigate. Now, another question we always hear is, or statement we always hear is, prices always come down in summer. So we've come back now to the long-term charts that we saw at the beginning, this time looking at gas prices. I think the perception is that in the summer, prices tend to come down because the prevailing conditions that we see in the summer. Usually that's when it's warmer, low demand, so therefore forward pricing should come down as a result. And what we're trying to show is a reality. It's that price will trend up and trend down and trend sideways, irrespective of season. So the notion that prices always come down in the summer is false. You can see here 2004 to 2006 uptrending. So if you were holding off at the beginning of April on the expectation that I'll buy some forward energy in Q3, you'd have missed out a low point. Same in 2005, etc. Obviously, the crisis situation, that was even worse necessarily. So the premise that you can hold off in the summer to lock in, again, it's a fallacy that necessarily you will see lower prices through the summer. I hope this is visually you can see that in a sense. But everything that's kind of bold in color is showing that where the trends are at different times. So again, it's always dependent on market conditions, like we said quite a few times through this presentation.
And then we just wanted to mention a few things around risk mitigation, both on price and generally on your contracts. So whatever type of contract you're looking at, we probably laboured the point a bit that market conditions is key. It is about timing when that contract is signed. The example we looked at earlier, a contract signed in April 22 was a lot cheaper than one that you'd sign in August 2022. So it's about when is the right time to sign. Are there risks that you need to mitigate by signing earlier, or are there opportunities to win by signing a bit later? Even if you don't sign, don't wait till the last minute to start looking at the contracts. Give yourself plenty of time to see what's happening in the market, understand what the trends are, what's driving the markets, and that will give you the opportunity to at least secure prices, at a time where rates are at least comparatively low in the trend. Don't assume that doing the same thing all the time will always work. I think it's about adapting to market conditions and being willing to do something a bit different depending on what the market's pointing to. For example, if you're currently in a fixed contract and conditions aren't as favourable as you'd like them to be, consider a flexible contract, because that could offer you that opportunity to make multiple purchasing decisions rather than the single purchasing decision with the fixed contract. You can sign a flexible contract and not trade it. You can sign and only trade a proportion of your energy. So it gives you a bit more of an opportunity in those circumstances. So I think be flexible about how and when you sign that contract and how long you sign that contract for. And looking at the supply contract itself, because your risk isn't just wholesale prices. Your risk starts to look at other factors. So if we can jump to the next slide, please. So payment terms, are the payment terms you're being offered long enough? You might be able to get longer terms with a premium if that works for you, avoiding late payment charges or keeping the cash in your bank account rather than the suppliers. Volume tolerances are something that perhaps have become more of a talking point in recent years. COVID, meant that a lot of people used a lot less energy than they were expecting to, and then in more recent years, the aim to reduce energy consumption due to higher prices. That has meant that for a lot of organisations, volumes have reduced or increased depending on what's going on in the markets or what's going on within the business. Does the volume tolerance on the contract meet your needs? Can it accommodate what you're expecting to happen through that duration? That big energy efficiency project that you're working on, does your contract take that into account? And does it have some flexibility for any delays to that, or any overachievement in that energy efficiency project. Terms and conditions, obviously all suppliers will have slightly differing terms and conditions. Be clear about what those mean, and there are sometimes room. There is sometimes room to negotiate on some of those terms, certainly not all of them. But if there's anything in there that is a deal breaker for you, don't be shy about asking to negotiate. And then finally, what do you do with your non-commodity costs? And that's something that we'll talk about in a lot more detail on the webinar next week. So I won't spoil the fun for that one. I'll hand back to William and let him talk, just sort of summarize what we've talked about. And you're on mute, William.
Might be best that way, John. Sorry, thank you. So yeah, just in conclusion, I'd say that the energy markets are volatile, they're unpredictable, and the price movements can be swift and significant. So if cost is an important factor for you, it's definitely something that you need to control. And a lot of the analysis that the models that we looked at today, it's all been looked at with the benefit of hindsight. And like John Dawson said earlier on, when you're looking at the price charts, you're only ever looking back at historical price movements and trying to quantify the risk to decide, well, in the context of your own risk appetite, do you want to maintain exposure, or because you can, and what are the opportunities maybe of doing so. So you are buying from a volatile market. There's no real way around it, unless you're going to be generating on site, or you're going to have a PPA sleeving into your import, or you're going to have a direct line bringing electricity to you. We all have to buy from the same market. So I think what we can say about the approach you should take is that it's best to be proactive, and you can't really rely on seasonal price movements, maybe like what would have been done a while ago, because from the analysis that we've seen, it was never really a foolproof way of managing the price risk. But nowadays, because of how the markets have changed, and being linked to the LNG, which is a global commodity, it's just too risky. If prices are significant for you. And the reason why it's such a risk is, when you want to manage how you're exposed to that market, if you're doing it via like a fixed contract process, if you want to do a competitive tender, it's going to take you about a week to do that. And you might have an internal sign-off process to follow, and being exposed to a market like that for a week can be significant in how much price difference it's going to be. So that's important. Timing is definitely critical. So for fixed contracts, it's the most important thing by far. You want to do a competitive process to try and get the best contract that you can. But the hedging decision that you make, and when you sign a fixed contract, is based on the day you sign that contract. It's based on those prevailing prices on that day, in a total and absolute purchasing decision. So you need to make sure that you make the best one for you to manage the risk and control budget and costs. If you're going to do a flexible route, there's a difference between the day you sign the contract and the actual trading decisions. So I would definitely say that it's best to secure a flexible contract as soon as possible, because it just means you can control the costs all that sooner. It takes a little while longer to secure a flexible contract. It'll take more than a week, but once you've got it, it's really the framework that you're establishing to then manage the risk of buying from that market. So once you've secured the contract and the trading strategy is being agreed, those trading decisions can be made within minutes to manage the risk. So you're not, being exposed to the market movements for like a week while they do whatever they do. You can establish, your budget, your strategy, and trading decisions can be made very quickly based on how the markets develop. Just to reiterate, the timing is the most critical thing. Buying power is sometimes spoken about, within certain models, grouping together as a collective to have greater buying power, and it probably has some merit for improving a competitive process. With a bigger volume, you might have more suppliers involved. You might be able to get a marginally better price for the hedges that have been made. But when you compare that against the significance of the volatility in the market and how the prices can move, it's so insignificant that it shouldn't be prioritized. And in fact, some group buy-in models, they kind of compromise you as an individual. So it'll compromise how you can, influence the timing of your own contract and, what you want to do as an individual. So I would definitely prioritize the timing of contracts above anything else, whether it be a fixed or a flexible route to market, because we're all buying from the same market. It's the cost element that it's definitely significant. Obviously, non-commodities can be significant too, but there's not really a great deal you can do about those, like we'll talk about next week. But the commodity cost, it is within your control for the choices that you make as a buyer. So you can make alternative decisions to mitigate the risk and get better value. Also, it's definitely better to have a bespoke strategy to meet your needs and your objectives. Just to say as well, if anyone does have any questions that they've thought about throughout, we'll have the time at the end. But if you want to post them now, then that'll be appreciated. So have a bespoke strategy to meet your needs and your objectives. So there's not one strategy, that's best for everybody in all environments, but it's definitely better with a flexible approach to have, to start early, to maximize the control and the options available to you. Like I said, you sign the contract, you're not hedging everything, you're not hedging necessarily anything at all. You're just establishing the framework to manage the risk. So the sooner you do that, the better. Because, like I said, you can cover the risk within minutes rather than days. With the flexible route that you choose to have, the strategy that you implement, whether it be like some market tracker with triggers or a budget protection or whatever it is, I would always promote the benefit of having as much flexibility and adaptability as possible. So a lot of the the models that were looked at by John earlier was looking at fairly a simplistic view. It was just looking at like maybe a couple of seasons. But in reality, when you secure a flexible contract, you'll be looking at a much longer window. So you'll have different strategies for different time periods. So you'll take control of the front year, you'll take some control of the second year and the third year. So you've always got that window, that horizon where you're controlling your costs. I mean, like John Palmer said earlier, one of the benefits of the fixed approach is that it's a simpler process, and once it's done, you can get on with your day job, which there's some value to that. There's also a lot of risk as well, because if you get on with your day job and you take your eye off the markets, you can be caught out, and with the price movements that are present, it can be costly. So you definitely want to be engaged with what's going on in the market and having that long-term view and having a partner to keep an eye on it and make sure you're well informed. It just means that you can make decisions to achieve what to give you the right price mitigation and to get best value. I'd also promote having transparency. Not all flexible solutions that I come across are equal. Not all buyers have a lot of transparency. They opt for maybe a flexible solution, and they select a theme that the broker will conduct for them, as opposed to saying, this is exactly what I want, this is exactly what we need as an organization. And when you maybe go for a theme as part of a collective, and you compromise what you have as an individual, and you lose the transparency, you lose a bit of the control as well, because you can't see exactly what's going on for you as an individual. So I mean, I've heard of people who maybe have an April year and the prices get set like in the March just before, but if there are people entering the product or people leaving or people using more or less, there's a risk of cross subsidization. So you definitely need to have transparency and control, so you get exactly what you need, and you can adapt, based on how market conditions change, or like how your business needs change. So if you've got an estate that grows, a flexible contract can bring that stuff in nice and early to consolidate it all together. If you've got estate that's leaving, or you're bringing on-site generation on, you've got options within a flexible approach to accommodate all of that. And for fixed contract approaches, timing is absolutely critical. You definitely do a competitive process, but the most important thing really with the fixed approach is, the fact that it's totally binary. You're either 100% hedged or you're 100% exposed to the market. So, and it can move so quickly, and the fixed, approach to take that risk off the table is so slow compared to how fast the market can go. You've got to be proactive and be informed and probably be a bit pragmatic when you make your procurement decision. There's no point chasing the bottom of the market, because unless you can tolerate the risk that's present, it's just too dangerous to do that. So those are the main conclusions. It's not an exhaustive list of what you should do. It's just a few of the things that we think are the most important things to consider. Super. Any questions? Okay, so we've had one question that's come in. So I'll ask that one first. If anyone else think of any others, feel free to post them now. So the question is, are you seeing reduced volume tolerances on flex contracts? What tolerance bands are being offered for new contracts? John Palmer and John Dawson, do you want to offer some answers on that? You muted, John.
Make the same mistake as you, sorry. Yeah, I think we are seeing suppliers generally tighten up on volume tolerances. It doesn't mean there aren't wider volume tolerances out there. It just means that there are some suppliers who are more open to wider tolerances than others. I think we've seen probably some suppliers default to 90 to 110 volume tolerances as a percentage. I think standard is probably still more 80, 120. But yeah, there are probably fewer out there who are offering much wider volume tolerances. We are seeing certain suppliers, particularly on fixed contracts, who are willing to offer no volume tolerance. I suppose the other thing on flexible contracts, more around volume, is we've seen a number of suppliers who have perhaps moved from offering a sort of a base load volume tolerance type product to moving more, looking to move more customers to cash out products where volume tolerance is not a risk that the supplier is taking. They're passing that risk over to the customer.
Super. Thank you, John. I'll ask a question that came up in last week's webinar, just to say, because it was a bit about procurement strategy. One of the questions that was asked last week was about, well, what term of contract would you sign at the moment based on, current conditions? So last week, I think Ramnick suggested maybe a couple of year fixed for a fixed approach, and longer term for a flexible. I don't know if you guys would see it the same way, or if you'd answer it with any different way.
Sorry.
No,
Yeah,
you wouldn't.
go
Up to you.
Go yeah, I guess if we go to the long-term price chart, I can't remember which slide it was just before the
Which one, John?
just keep going left. Yeah, this one, and maybe just like that. So the question, I guess, would be, I'm trying to answer that, is if we can have the so the question I think we're all going to face here is
Sorry, it's doing its own thing.
Yeah. The question I guess we're going to face is, like I mentioned before, we've had this kind of range that price has been over since the I would call it around 30 pence in this case. I think it was 40 for the power as a floor, and then we have this kind of 60 to 80 as the peak in a sense, and maybe imagine that as a band in a sense where price has shifted back and forth. So there's been a structural change in the market, given that there is no more Russian supply, or there's a certainly heavily reduced Russian supply to Europe, that was also at much cheaper levels, because those were some long-term contract deals that were signed a long time ago based on the assumption. Well, the known fact, I think, is that that gas was at very cheap levels. I mean, mostly affects Germany per se, but it has consequences for the rest of Europe. So the move away from Russia as a supplier, just as LNG was growing in its influence in our pricing, has expanded even more. So we're reliant, I say we, but the market necessarily is reliant now on LNG supply, liquefied natural gas supply from the US, Qatar, and Australia as the main kind of producers. Yeah, US, Qatar, and Australia, and Asia, China, Southeast Asia, very high demand centers, Europe, UK included. So it's always going to be a dynamic between the high demand areas, Europe, Asia, versus and the producers, US, Australia, Qatar. Now, a lot of with the advent of this crisis and the way prices moved up, there's been a lot of potential supply, certainly US, that's being tapped into. The US can only export a certain finite amount compared to how much it can produce domestically. So what they're doing is trying to expand that output, how much they can actually send out. And in so doing, with the higher pricing, those who were getting Russian gas have, shifted to try to get from the US. And that's allowed for more financing for these projects to be built. There's usually a lag. So the expectation is that 2026 onwards, we should see more LNG come into market. So we will be influenced a lot more with liquefied natural gas. What is interesting from a behavioral point of view, where price got to, was what was seemingly the top of that range so far. Now, if you were coming to market now with this structural change that's happened, you've got a stable supply that has gone in the form of Russian supply, and now we're more reliant and we're having to compete a lot more this time now for product that's coming on. So getting to the top of what was a normal range, the question is, there's risk to the upside because of the structural change. We're quite reliant on LNG, and we're very reliant on Norwegian supply. Anything happens with those two, then it feels like the market will have an exponential reaction to that. So Norwegian supply is very, very critical at this point in time. We've basically narrowed our supply routes, options, in a sense, taking a massive one out of the equation. So anything happens with Norwegian supply would have a massive reaction to price. And equally also on the downside, what would cause prices to come back down into the range? We could have a lot more LNG supply coming to market compared to the expected demand. We could have an oversupply situation. An oversupply situation would probably see us going back into this what was a normal range between 30 and 60. So there is no right answer right now. It's only with hindsight that you can know you're right. But if you were coming to market now, you take the fixed route, you can see where price is relative to where we were historically. You'll be certainly insulating yourself against any possible upside between now and say 26. So that's what we're taking, maybe a 2-year deal, somewhat, and then trying to see whether 26, 27 onwards we'll see this, if this dearth of supply that's coming on will keep us in a low market environment, low volatility kind of price environment. If you were taking the flex, then you can sort of cap your costs here in a sense. And if the prices were to drop down, you'll be able to take advantage of that because you can have exposure to that. But you've got yourself an insurance policy as well at the same time of capping your cost.
Yeah.
So that's the positive of the say you can take a longer view on the budget on a flex contract.
Yeah.
And it allows you to react if prices move up, or just leave exposure if the prices then decline. So it kind of gives you a bit more wiggle room in a sense. If you take the fixed price route, maybe the more shorter term makes sense at this point, but like I said, it's not advice we're necessarily giving out at this point. It's just a view now. We're in a weird phase in the market, between a structural change that's happened on the supply.
Yeah.
But there's equally going to be another structural change in the coming years as well. So between those two, we've had a high volatility because of supply going off, and we're going to at some point see high supply come in. But yeah, where will we be between the two? So there's still a lot to happen between now and then, I think.
Yeah. So I guess the answer is that because the market is so uncertain, people have to make a choice based on their own risk appetite, and there's definitely a price risk of being exposed to the market. It's just, I guess, being considerate of that to make sure that you don't get caught out by trying to chase lower prices. Super. Anything you wanted to add to that, John?
No, I think John's covered it all.
Yeah, but I definitely agree that with the fixed approach, it is the timing's everything. With the flexible approach, you got more options, haven't you? So it's not just a timing thing for the security of the contract. It's it's just putting a contract in place to maybe draw a line in the sand, protect yourself on the upside, and still have some opportunity on the downside. And because it's not all the eggs in one basket, you can have more confidence to do it for a longer term. Give yourself that more control. Super. Someone else asked, are there any trackers you would recommend we can use?
I mean, I'd suggest market intelligence. Obviously, that's something that we can provide. But I would say, look at market reports on a regular basis. It will give you an idea of probably the key things that are happening in the market, whether we're seeing prices heading up, down, or sideways, and that would be what I'd be keeping an eye on, looking out for. From the point you start tracking what is the market doing, what are we seeing happening, that also gives you an idea, potentially of if you know roughly where wholesale prices were when you actually signed your current contract. It'll give you an idea of what the differential is between that contract and your where you're likely to be buying at going forwards.
Yeah, I think it's probably not just about the tracking either. It's about the interpretation as well of the market, because I think there's lots of data available fairly freely. If you want to get pricing information or anything like that, but it's being able to put some context to it as well to decide what do you do based on the information available. And yeah, like you said, John, we do provide market intelligence. So yeah, I would probably use someone like us to get that kind of data. Super. Well, we've got 2 minutes left, but there's no other questions. So unless you've got any final thoughts, John and John, we'll wrap it up there. Nope.
Yeah, I think we've covered it all.
Cool. Well, next Tuesday we do have a session about the non-commodity market. So which a bit different to this one. It'll be a bit more talking about what the costs are really for budgeting them, understanding what's going to be happening, as opposed to how you can control them, because options are a bit limited in that regard. But it should be a good session with Ashley from our market analysts. So I'm looking forward to that. But yeah, if you think of any questions after the session and you want to submit them, then feel free to do so. But thank you for your time today.
Thanks, everyone.
Thank you. Thanks, everybody. Bye-bye now.
Bye.